If you are watching this video, you are probably wondering, what is the stock market? What stock is going to make me $1 million? How do I make money? How do I lose money? Is it too good to be true? I will answer all those questions in today's video, and by the end of the video, you will understand everything from what is the stock market, what is a stock, why do people invest, how do you invest, and some tips on investing. My name is Ethan Chase, and I post videos every single day on the stock market and weekly videos on investing, personal finance, and life. Okay, if you want to understand the stock market, you first need to know what a market or a marketplace is. So I'm going to give you an example. Imagine you have a super cool hoodie that you want to sell because you want some cash, or for whatever reason you just want to sell it. So you make an offer, online, you hit up your friends, what have you. And you say to your friends, this is my hoodie, I want to sell it. This is my price, but I'm open for offers. So right there, you have just created your own marketplace. It's that marketplace for selling your hoodie. That marketplace now exists, and it's between you and anyone else who wants to come in, participate in it, and potentially buy your hoodie. The stock market is the same exact thing, except on a much wider scope. And instead of hoodies, you can buy and sell stocks or shares of a corporation. The stock market today wasn't always as simple as downloading an app such as Robinhood, going on the app to buy and sell shares. What you had to do was actually call up a broker on the phone, someone whose job was to buy and sell stocks for other people. And there was a massive in-person hub called the New York Stock Exchange, where people in person, that's their full-time job, would be buying and selling pieces of companies. This was called an open outcry market, where people on the floor, it was called in the exchange, would yell across the room and use weird, hand motions to buy and sell shares. But now, due to technology, everything has moved online. So now, so simple, you could just download Robinhood, go on the app, put money into the app with an account, and then buy and sell shares. The next question we need to go through is, what is a stock? A company's stock is just the equity portion of that company. You can go back to the famous equation, assets equals liabilities plus equity. And equity is the retained earnings of the company. So what it is your net income subtracted from the dividends that you pay out. In simpler terms, it is just the equity portion of that company. And you could invest and become a partial owner of that equity by investing in what are called shares. So if you own shares of a company stock, if you own shares of Apple stock, that means you are a partial owner, a shareholder of the Apple company. And that's crazy, and it's very much overlooked, right? People think the stock market is kind of risky or gambling or a way to get rich super quick, but really what it's about, the stock market came into existence was for people to invest in companies. So you take a stance, you think, I believe in this company, I believe in Starbucks, I believe in Apple, I believe in Facebook, and I think the value of that company is going to go up over time. So right now, I'm going to invest money and purchase stocks or shares of this company. So when you become a purchaser of stocks or of shares, you become a partial owner. And that's something you should celebrate, right? That is you becoming a partial owner in a company. It's crazy to think about. Sometimes the company will send you letters where you can actually vote on stuff that's happening inside the company. Obviously, your vote's not going to matter as much as a member who's on the board of the company, but you still have some voting power. That's not to say that you're going to, you could just hit up Elon Musk and to tell them what to do with their company, because one share doesn't really have any influence. But it's so cool to say and to tell your family friends, I am now an owner of a company. The stock market is just the center place, the exchange, the market, the marketplace where people go to buy, sell, and ultimately trade their shares of different publicly traded companies. Now that you understand what a marketplace is, and what the stock market is, and what is stock in a company or shares of stock in that company, now it's time to understand why people invest. And of course, investing does carry risk, and if anyone tells you that the stock market is bulletproof or it's guaranteed returns, then they're straight out just lying to you. The market can be very risky, especially if you don't know what you're doing and you invest blindly. This is not to say that you can't make money in the stock market, and of course you can, and it wouldn't be popular or highly coveted or highly touted if that wasn't true. We know that the mean historical average of all time, the annual return on average for the stock market, is anywhere from 7 to 10%. What that means is if you invest, let's say $1,000 into the general market, you can expect on average to see a return from 7 to 10% on your money. This does not mean that if you invest right now, a year from now, you should see 7 to 10%. You could very well lose money, or you could even make much higher than that. The 7 to 10% number is just the historical average. The general idea of why people invest in the stock market is something known as compound interest, or compounding your money. What it essentially boils down to is the fact that the more money you have, the more money you will make. And over time, as you start to make a little bit of money in the stock market, then that new money you just made will start earning money. So what you expect to see is an exponential curve of your money. Let's say you put $1,000 in the stock market. Say, and these are all hypothetical numbers, you put $1,000 in the stock market. Let's say the first year you make $50. So now you have $1,050. So that was a $50 return. But in the second year, you're not investing only $1,000, right? You're now investing $1,000 plus the $50 you just made the first year. So now your return can maybe be $150 or $100. So the point is your money will start to grow on itself and make money on itself. That is compounding interest, and that's the real reason why people like to invest in general, but especially in the stock market. If you have stayed with me this far, congratulations, because right now you're about to open up your first investment account, and that is crazy because this is the first step that you are taking to achieve your own financial independence and financial freedom. Remember, this is not a short-term thing where you're in and out. It's about the long term. It's about growing your money slowly, wisely, and safely. To open up your account, you are going to need a brokerage platform, and essentially what that is just a platform, a medium, or a middleman for you to buy and sell stocks on the stock market. What I recommend is Robinhood because there are no commissions for when you execute a trade, and the user interface is so simple to use and nice. I have a link to it in my description. If you use my referral link, we both get a free stock, so take advantage of it. It's an awesome opportunity. But the information you're going to need is basic information like your name, your address, your social security number just for authentication purposes, but also a bank account so you can wire money from your bank account into your investment trading account. So this is what Robinhood looks like. It's going to ask you for some information, and then once you submit the information, what you essentially did was create an application to have an account approved. Robinhood says it takes around 24 hours to approve the application, but once it's approved, then you could start trading. Once your account has been approved and you put money into your account, this is what it's going to look like. As you can see, I have around $970 in my account right now. I have around $517 of buying power, meaning that's how much cash I have to buy stocks right now. If you want to search a company, all you have to do is click the magnifying glass, and this pulls up the browse screen. On this screen, you can see a bunch of different headlines relating to the markets on that current day or the current weekend. What you want to click is search companies, and this brings up the search bar for you to search any type of company you want to search. Let's try Apple. So when you search a company, it brings up this page. You can see Apple with a ticker AAPL. That's kind of the code word that the markets use for Apple. You can see today, meaning really Friday, it was down 0.59%, and after hours in the market, it was down around 0.35%. On Robinhood, you have the different types of chart. You have a one-day chart, which shows the price for that one day. You have the weekly chart, which shows the price for that 1 week. The same thing for the month, the 3-month, the 1 year, and the 5 year. So with this, you can see kind of the price action over a certain time period, and this gives you a sense of what the stock has been doing in that given time period. You can also scroll down to see certain stats about the stock itself. You'd see what the price opened at that day, the high it was that day, what was the lowest price. You see the yearly high, the yearly low, and a bunch of other statistics like volume, how much or how many shares of that stock was traded in that time frame. Then if you scroll down, you can see news about the stock, and eventually you can go ahead and click trade. But before we trade stocks, we have to understand what influences the price of a stock and what are good practices when investing in stocks. And now you're finally going to start investing in the stock market, and this is very exciting. But you have to be careful because you can't just get too excited and hop into the market without doing due diligence. A disclaimer, I am not a financial advisor. All these opinions in this video are my own, and this video is purely meant for entertainment purposes. Don't take any of my ideas as investment advice. You need to do your own research and due diligence before investing in anything so you can understand your risks and potentially how much money you can lose. First, you need to understand what influences the price of a company's stock. And there's really three levels to this: the company level, the industry or sector level, and then the general market level. Let's look at the company level. In the company level, this is all news and headlines related to the company itself. For example, if a company reports good earnings, the price of that company's stock may go up. Likewise, if they report bad earnings, you might expect to see prices go down. If the company releases a new product or new service, let's say Apple releases a new iPhone, and everyone thinks that iPhone is revolutionary and is going to change the smartphone game forever, the price of Apple stock may rise. Next, to the industry or the sector level. This is the kind of playing field that your company is in. If again, you have Apple stock, you want to be looking at Samsung, at Microsoft, and all the other technology players that offer smartphones or laptops, etc. If your competitors are doing well and they're starting to take market share away from your company, that could be bad. That could drive the prices of your company's stock down. If Microsoft comes out with a crazy phone and people start buying it over an iPhone, then the price of Apple stocks may go down. The third and the general, more broader level is the stock market itself. You need to look at general macroeconomic conditions. How is the American economy? Are we in a trade war? Are we in a physical war? You have to look at the market itself. If people don't believe in the American economy, or for example, there's a worldwide pandemic, people may not have confidence in the stock market and people will start to sell their stocks. If this happens on a wide enough scale, then your company may be impacted as well. Now, since we understand what impacts a company's price, we should get into general investing philosophies. There has been so much literature written on investing, and for me to sum it up in a couple minutes would be impossible. What I am going to do is give you a few pointers on what I look for when I'm investing potentially in a company. The first thing I need to know is what is the core business of the company. If I can't even understand what the company does or what it offers, there's no point for me to invest in them because I don't even know how to measure my risk. For example, I'm not knowledgeable about the healthcare industry, so I'm not going to invest in a company that makes some random drug that will cure a disease because frankly, I dislike reading the scientific literature and I just don't have the tools to understand it. And because of that, I'm not going to invest in those companies. What I do understand are stocks like Apple or Starbucks because I use them and I interact with their products and services on a daily basis. That's super important because when you're trying to invest in a company, well, all you're essentially doing is creating a story and a narrative around that company. You want to figure out what has happened to the company in the past, what is currently happening to the company now, and what will happen to the company in the future. And to form that narrative, you can use a few different tools. You can look at the company's financials. You can read about the competitors. What are the competitors up to? And then you could read about the sector in general. What is happening to the overall industry and where does your company fit into that picture? There's a bunch of resources out there to analyze stocks. I love Yahoo Finance or Google Finance because they're super intuitive and easy to use. The next thing I look for is whether or not a company pays a dividend and how large that dividend is. There's many videos out there on what dividends are, but essentially it's just a company paying you to own their stock. It's free money essentially, and it's always a plus when a company pays it out because it's usually a good indication of the company's financial well-being. Some stocks have super high dividends, which is actually a bad sign because that could mean that they're just hungry for people to buy their shares. All in all, you need to do a bunch of research before investing in a company, because at the end of the day, it's your money and you want to make sure you're investing in a company that you truly believe in and that you truly think will have success long term. Again, I cannot emphasize this enough. There is a major distinction between trading the stock market and investing in the stock market. What you want to do as an individual who is young and has a bunch of time before they retire, you don't want to be trading the stock market. You want to be investing in the stock market. And that distinction is what's going to prevent you from losing a lot of money in the long term. At the end of the day, what you're doing is you're taking a stance. And you are believing in a company and that company's growth potential in the next 10, 15, 20, 25 years. What I like to do is invest in good quality stocks that you know and you understand that potentially also pays a dividend so you can earn even more money. Investing can be risky, but if you know how to pick good quality stocks and how to manage your risk, it can be a very lucrative way to make money. Another investment tip is not to use all your money into one company. That's not smart. You don't want to put all your eggs into one basket. This is called diversification. You want to diversify and invest in different companies and different sectors so you have more exposure to different parts of the market. This prevents, for example, if all you invest in is technology stocks and let's say that industry isn't doing so well, then your portfolio is not well positioned in the market. But if you invest in technology stocks, but also in the utility sector or the consumer staple sector, then you have more exposure to the general market and less risk to individual sectors. With this in mind, it is now time to actually physically purchase the stock. And to do that, you want to open up Robinhood, click the magnifying glass to search, find the company you want to purchase. Let's go with Apple. Search it. You hit the button that says trade, you hit buy, and then you enter the amount of shares you want to purchase. After you do that, you hit review, and then you swipe up to submit the order, and that is it. You are now a partial owner of the Apple Corporation or whatever company you purchase, and now those shares are yours. Now that you're invested in the stock market, you're not done yet. You have to constantly monitor your positions to make sure that they're doing well and the overall market is in safe conditions. For example, if you weren't reading the news the past couple months and you're still in the stock market during the massive explosion of COVID-19, you would have seen your portfolio drop by a lot, and that's not good. What I'm about to tell you is what truly distinguishes novice investors from more seasoned, experienced investors. And the idea is you can't get too emotional over the investments. Every single second during trading hours, the price of your stock will fluctuate, and that may scare you and that may be nerve-wracking. But at the end of the day, you're not in the stock market for a day or a week or a couple months. You're in it for many, many years because you are utilizing compounding interest. So whether the stock goes up 2% or down 2% in a couple days has really no overall massive impact on your portfolio if you think about it in the long run. If you get nervous because you see your stock sell off a little bit, that's not a good solid reason to sell your shares of that company. The only time you should really sell is if there is a massive worldwide pandemic or a market sell-off like we're experiencing right now with COVID-19, or if your core thesis on the company has changed. If you still truly believe in your company, barring all other market conditions are okay, then you should hold on to that company. If your core thesis changes, then that is when you pull the trigger and you sell the stock. Now, you shouldn't always fall in love with companies because over the long run, many companies fail. But there are still some good, solid companies that will survive and will adapt and innovate, and those are the companies you want to be invested in. If you enjoyed this video, please show me some support as it took me a lot of time to make. Please hit the like button so the YouTube SEO algorithm could pick up on this video and more people could view it like you did. Comment down below if you got started in the stock market or if you have gotten started recently, and let me know what your experience has been like. And lastly, please hit the subscribe button because it really helps me out. I am on a journey to financial freedom and independence, and this YouTube channel is one step in that process.